After a hopefully restful summer, we pick up where we left off with our economic outlook update. So welcome back. It was a summer where a lot happened on the economic front. There was a presentation of the ECB's new policy strategy and the Jackson Hole conference where the Fed gave more than a few hints about possible tapering. But there was also news closer to home. After one of the worst recessions in its history, the European economy returned to growth. The final growth figures for the second quarter confirmed a very strong and better than expected economic recovery of around 2.2%. And with that, Europe is finally joining the other economies, first and foremost the US and China, which had already started the economic recovery earlier. However, the crucial question remains whether this early economic recovery will last. Not everything is running according to the optimal theoretical scenario. The global economy is confronted with disruptions in supply chains and supply lines for longer than expected, and inflation is picking up strongly. Tensions on the labor markets are gradually increasing, and central banks are now facing the difficult choice between additional support on the one hand or a first reduction of the so-called steroid cure. According to our economic outlook, there is nevertheless reason for moderate optimism, even if the uncertainty remains high. Vaccination remains the game changer. Thorough vaccination may then not prevent new infection waves, just think about the Delta variant, but it does reduce the risk of hospitalization and thus reduces macroeconomic impact and the need to introduce new generalized lockdown measures. This trend is most clearly visible in Europe, where despite this Delta wave, economies are gradually and intermittently reopening. Increasing demand and the shifting consumption from goods to services are important drivers of this so-called catch-up growth. In the short term, however, the risks to economic recovery remain on the downside. Supply constraints and limited vaccinations in a number of Asian countries are leading to pressing shortages for certain crucial components. Just think of semiconductors. In the short term, these supply shortages translate into significantly longer delivery times, reduced production, and sharp price increases for intermediate goods and basic materials. However, these disruptions are mainly to play in the shorter term. In the somewhat longer term, we expect a better match between supply and demand as the supply side catches up and demand shifts further towards the services sector. Now, despite these bottlenecks, we still continue to expect a strong growth in the major economies, and particularly in Europe and in the United States. In the meantime, this economic recovery is starting to filter through to labor markets. The doom scenario of mass unemployment and structural damage to the economy seems to have been averted for the time being. On the contrary, employment in the US and in Europe is recovering relatively fast, and the unemployment shock caused by the COVID crisis remains limited overall. In any case, the unemployment outlook does not weigh on economic sentiment. Perceived unemployment risks are back at pre-crisis levels, supporting this persistent optimistic consumer and producer confidence. In some countries, we are even seeing the first signs of tightness in labor markets, with vacancies not being filled or not filled quickly enough. Now, whether this tightness is the result of temporary support measures and fear of contagion, or is rather a reflection of structural change in employment preferences and therefore scarring, remains for now unclear. But it is starting to weigh on short-term growth prospects. Inflation remains a major concern. Over the summer months, inflation continued to rise due to a number of technical factors, to base effects, primarily energy, and to reopening effects. Headline inflation rose to well above 5% in the US and to 3% in the euro area. And although most of this surge in inflation was expected, it is nevertheless causing some nervousness in markets, especially since the inflation outcome was higher than initially thought. However, given the one-off nature of most of the inflation drivers, we expect most of this surge to be temporary and for inflation to normalize over time to levels broadly in line with central bank inflation targets. This scenario is also supported by financial markets and by a large majority of analysts. Inflation risk, however, remains strongly on the upside, and new inflation spikes later this year can certainly not be ruled out. The central banks, and in particular the Fed, are now at play, and the data don't lie. With inflation well above its inflation target and the economy now running at full capacity, the Fed is achieving 2 of its 3 objectives. The third goal of an inclusive employment recovery is within reach, and financial markets expect clarity. Fed Chairman Powell's message at Jackson Hole brought more clarity indeed. The Fed is preparing for the exit and tapering is likely coming. But the link between tapering and possible future rate hikes was weakened. The ECB, on the other hand, is sticking to its traditional mantra of maintaining favorable financing conditions. But with inflation and inflation expectations picking up and the economic recovery taking hold, it is slowing down its purchases under the PEP program. The ECB remains vague, however, regarding a possible termination of this PEP program in March next year. But overall, the scene seems to be set for moderate rises in the longer-term interest rates. All in all, positive news, but the confirmation in the autumn and in winter remains crucial. The European economy now seems to have turned the corner towards recovery. Inflation is picking up more than expected but remains largely temporary, and the central banks are now more than ever at play.